Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about H.B. Fuller Company Annual Report. H.B. Fuller Company offers a diverse range of products and services across various industries. The company's product portfolio includes adhesives, sealants, coatings, polymers, tapes, encapsulants, additives, and specialty chemical products. The company operates through three main segments: hygiene, health and consumable adhesives, engineering adhesives, and construction adhesives. In the hygiene segment, H.B. Fuller produces industrial adhesives for packaging, converting, nonwoven and hygiene and health and beauty markets. The engineering segment supplies high-performance industrial adhesives to industries such as durable assembly, transportation, electronics, clean energy, aerospace, and defense. The company's construction adhesives segment provides products used in tile setting, commercial roofing, heating, ventilation and air conditioning, insulation applications, as well as caulks and sealants for the consumer market. H.B. Fuller sells its products directly to customers through various channels, including distributors and retailers across North America, Latin America, Europe, India, the Middle East, Africa, and Asia Pacific. The company's extensive product offerings cater to a wide range of industries, making it a leading provider of specialty chemical products globally. The stock price of H.B. Fuller Co. has made no significant changes in the past year, despite several news events that could have potentially impacted it. The company's financial results were mixed, with some quarters showing improvement while others experienced decline. In its first quarter fiscal 2025 results, H.B. Fuller reported a 2.7% decrease in net revenue and a 7% drop in adjusted EBITDA. However, the second quarter saw an increase in EBITDA to $166 million, with an expansion in EBITDA margin by 130 basis points to 18.4%. The company also achieved positive organic revenue growth, driven by a 0.7% increase in organic pricing. Despite these improvements, the stock price declined 3% over the past 12 months and plummeted 6% following its latest earnings release. The lack of significant change in H.B. Fuller's stock price can be attributed to several factors. The company's mixed financial results may have created uncertainty among investors, leading to a decline in stock value. Additionally, the modest guidance for 2026 may not have been enough to boost investor confidence and drive up the stock price. Furthermore, the quarterly dividend announcement of $0.235 per share, payable on February 19, 2026, may not have had a significant impact on the stock price. The company's Fuller Impact initiative and new board appointment may also have been overshadowed by the mixed financial results and modest guidance for 2026. In conclusion, the lack of significant change in H.B. Fuller's stock price can be attributed to the mixed financial results, modest guidance for 2026, and uncertainty among investors. The company's efforts to strengthen community partnerships and provide a comprehensive update on its strategic vision may not have been enough to drive up the stock price. H.B. Fuller Company maintains a market capitalization of $3 billion, broadly in line with the industry peer group. H.B. Fuller Company trades at a higher price-to-earnings ratio of 22 times and a lower price-to-book ratio of 1.64 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 63% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. Firstly, innovation and expansion play a significant role, with research and development driving new product development and penetration of new markets outside the United States contributing to revenue growth. Organizational efficiency also has an impact, as successful integration of acquisitions and productivity improvements through organizational restructuring enable companies to optimize their operations and increase revenue. External factors such as changes in economic, political, regulatory, and social conditions in international markets can either positively or negatively affect revenue growth. The demand for key raw materials is another crucial driver, with fluctuations in supply and demand conditions affecting revenue. Additionally, natural disasters impacting key raw material producers and changes in feedstock costs and inventory levels can also impact revenue. Economic indicators such as housing starts and construction activity, currency fluctuations, product pricing, and sales volume all contribute to the overall revenue growth or decline. Finally, internal factors such as organic revenue growth, mergers and acquisitions, M&A, and gross profit margins also play a significant role in determining revenue growth or decline. The net income of a company has experienced fluctuations over the years due to various factors. In some instances, it decreased significantly, such as in 2025 when international operations were adversely affected, resulting in a $2 billion decline in net income. Additionally, foreign currency rate changes and currency fluctuations also negatively impacted net income. However, there have been instances where net income increased. For example, from 2024 to 2025, the company saw an increase of $21.7 million in net income due to higher product pricing, lower raw material costs, and a decrease in other manufacturing costs. This led to an increase in profit margins by 130 basis points. The changes in profit margins can be attributed to various factors, such as changes in product pricing, raw material costs, and manufacturing costs. The company's ability to adjust its pricing strategy and manage costs effectively has contributed to the increase in profit margins. But the company's financial performance indicates a fluctuation in its ability to generate positive operating cash flow. In 2024, the company achieved a significant milestone by generating $168 million in positive operating cash flow. However, this trend reversed in 2025, resulting in a negative operating cash flow of -$5.1 million. This shift highlights the importance of monitoring and addressing any underlying issues that may have contributed to this decline. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, there was a slight increase in total long and short-term debt by $6.3 million from 2024 to 2025. However, this trend was reversed as the company repaid a substantial amount of debt, with $1,305.4 million paid back in 2025 compared to $1,764.9 million in 2024. In terms of interest expenses, there is some inconsistency in the data provided. According to one source, interest expenses remained relatively stable from 2024 to 2025 at $133.3 million. However, another source suggests that a 1 percentage point change in interest rates would result in an increase of approximately $6.6 million or $0.12 per diluted share. Overall, it appears that the company's debt level has decreased significantly, while interest expenses have remained relatively stable or increased slightly. The company's performance varied across different segments and regions. The Building Adhesive Solutions segment stood out as a strong performer, having been formed by combining successful segments. On the other hand, North America flooring business struggled, with its sale in 2025 marking a significant decline. In terms of regional performance, North America was a notable success story, with increasing sales reaching $1,234 million in 2025. In contrast, Europe, EIMEA, experienced a downturn, with decreasing sales totaling $543 million in the same year. The Asia-Pacific region had a mixed performance, with increasing sales but lower than expected at $234 million in 2025. The Asia-Pacific region also faced challenges, with lower cash flows from operations and higher use of cash contributing to its poor performance. Overall, while some segments and regions showed promise, others struggled, highlighting areas for improvement and potential opportunities for growth. Management's outlook for the company is one of growth and innovation. They aim to continue expanding in current markets through new product development and innovative solutions that support customers' sustainability programs. The company is investing heavily in research and development to create high-performance products, which will drive future growth. In terms of strategy, management is focused on driving capital allocation to the highest margin and growth market segments within the functional coatings industry. They plan to accelerate top growth priorities in EIMEA through acquisitions, positioning the company for long-term success. Regulatory compliance remains a concern, particularly with emerging regulations on PFAS. However, management believes that cash flows from operating activities will be sufficient to meet short-term and long-term liquidity needs. The company's robust cybersecurity strategy and adequate production capacity also provide a solid foundation for future growth. Overall, management is optimistic about the company's prospects, driven by their commitment to innovation, sustainability, and strategic capital allocation. The company has made several strategic moves through acquisitions and divestitures in its history. In terms of acquisitions, the company has purchased Royal Adhesives at an unspecified date, as well as another business from a third party in 1976. Additionally, agreements were made with sellers that tied payments to the entity's financial results. These acquisitions suggest a focus on expanding the company's operations and capabilities. However, not all of its ventures have been successful, as evidenced by divestitures such as the sale of its North America flooring business and the exit of a product line. These moves indicate a willingness to adapt and adjust the company's portfolio in response to changing market conditions or strategic priorities. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts each year. In 2025, it declared dividends totaling $50.3 million, while in 2024, it paid out $47.6 million. Furthermore, the dividend per common share was $0.928 in 2025, indicating a steady payout to shareholders. In addition to paying dividends, the company has also engaged in share buybacks. In 2025, it spent a total of $60.7 million on buying back shares, while in 2024, it allocated $39.6 million for this purpose. These efforts demonstrate the company's focus on maximizing shareholder value through both dividend payments and strategic share repurchases. Concerns about inventory buildup and supply chain disruption. The possibility of inventory buildup and supply chain disruption is a pressing concern for various reasons. Firstly, fluctuations in global market conditions have led to increased prices and reduced availability of raw materials, resulting in strained profit margins, page 5. This strain can further exacerbate the situation if supplier production outages occur. Furthermore, macroeconomic risks such as foreign economic, political, regulatory, and social uncertainties pose a significant threat to international operations, page 6. The Quantum Leap Global Supply Chain Restructuring Initiative may also be hindered by delays or unexpected costs, preventing the realization of its full operational and financial benefits. Additionally, external factors like military conflicts, e.g., Russia-Ukraine, can impact energy prices and logistics, while catastrophic events can disrupt operations or suppliers' operations, page 7. Moreover, natural disasters can cause supply chain disruptions due to their unpredictable nature and potential for widespread damage, page 12. These concerns collectively highlight the vulnerability of supply chains to various risks, underscoring the need for proactive measures to mitigate these threats. That concludes the financial summary for H.B. Fuller Company. Feel free to comment below, and I will be happy to answer them when possible.